The wild markets are placing new emphasis on ETFs that are tactical in nature, that is, those that are not tied to indexes and can quickly allocate and reallocate resources. Let's talk to one of those managers. Katie Stockton is the founder and managing partner of Fairlead Strategies. She also manages the Fairlead Tactical ETF, and also with Troy Donohue, he's head of America's portfolio trading at BTIG. Katie, before I ask you about your ETF, you're a long-time active manager. I know I've known you many years. Just tell us, what are you doing now and what are you advising your clients?
Well, there has been a very distinct loss of long-term upside momentum behind the S&P 500, and with that, some of the sectors that we like to invest in have fallen out of favor. So what we try to do is help investors leverage the upside through sector rotation, but also minimize drawdowns. And that's obviously a big advantage longer term when you can just go into a less deep hole to climb out of. So with that, we have the ability to use asset allocation to manage risk, not just that sector rotation.
Yeah, so your tactical ETF, TACK, T-A-C-K, the symbol, folks, just passed the 3-year mark. That's important because people look at benchmarks. 1 month, 1 year, 3 years, a typical important benchmark. Now you rotate between the 11 S&P 500 sectors, these equity sectors, but you also have gold you can rotate into, and long and short-term treasuries. And I know it rebalances every month. So where is this invested now? Right
now it leans defensive, but we still have an 87.5-ish% exposure to the equity market, which is remarkable because we've managed to outperform the S&P 500 by a good measure this year despite that nearly full equity exposure. And we've done that through more defensive sector exposure. So we own consumer staples, utilities, real estate sectors, whereas we don't own technology anymore. That's a new sector that we've removed from the portfolio because of its loss of long-term momentum. And we took that position and we put it into gold, we put it into the short-term treasuries, which is our sort of cash equivalent, and then also long-term treasuries. And it's that diversified risk-off exposure that can help us outperform.
So this is fairly defensive when I look at it. So you, consumer staples and utilities are there, and you have a small weighting in long-term treasuries, 4.5%, short-term treasuries 4.5%, gold 4.5% here. No holdings in tech, as you mentioned, but it's still almost 90% stocks, excuse me, 87% or so. Is that going to change at all?
I think it will. So it's a model-driven fund. It's 100% systematic. So we developed the model over the course of years and took our indicators, collected them to arrive at conclusions about these sectors. In 2022, when the fund launched, it went to just one sector with a 12.5% position. And that means we held the 87.5% in those risk-off categories. So it has that ability to really be dynamic, not just among the sectors, but among those other categories. And that's helped it over the long term minimize the drawdowns. Every drawdown more than 8% in the S&P 500, TACK outperformed both the S&P and its primary benchmark.
You know, Troy, let me bring you in here. There have been a lot of attempts at developing tactical ETFs out there. There's some fairly large ones, and even in the $3 billion range. I know First Trust has one, Pacer has one. But outpacing the S&P 500 has really been very difficult in the last few years. What's the issue, and under what conditions might a tactical fund outperform?
It's a pleasure to be here with you and Katie.
Thank you.
We actually worked together for a number of years.
That's right. Katie was at BTIG for a number of years.
It's good to see you.
She was always well renowned for her technical analysis, so it's great to see it in an ETF product that has performed really well during this recent drawdown. TACK is a great example of how you can be nimble during these market times, and these tactical funds have the ability to rotate very quickly and move into positions that might otherwise be longer down the line. So we've had a big run up in the last 2.5 years, and investors were sitting in more beta products. Now we've had this dramatic pullback, and investors are looking to protect capital and make sure they don't have these big drawdowns in their portfolios.
But it has been tough being a tactical manager for a long time now. I mean, if you just sit and own the S&P 500 basically for the since the financial crisis, really, you've notably outperformed. I'm an old Jack Bogle disciple, everybody knows that, and Jack used to talk about mean reversion, that it's a very real thing. We're finally getting a little bit of mean reversion maybe, maybe not so much in the bonds, but we're getting some mean reversion in the markets. Certain global markets are outperforming. Defensive sectors have been doing well for a good part of the year as well. That's contrary to trend. That's certainly nice to see. It's a vindication of the mean reversion crowd at this point, but still, it's been tough.
Yeah, it's certainly been very tough, but I think these are the times where tactical ETFs can differentiate themselves and show that their approach and their diversification from the rest of the market can help benefit investors in their portfolios, because they can provide those asymmetrical returns and help avoid some of those big drawdowns that we've seen.
Yeah. So Tati, I just wanted to say, your strategy would underperform if tech was dominant, which is what we've seen in the last few years, and it would outperform if the market was dropping and bonds were rallying, for example. I'm just trying to get a sense of how it would outperform.
Yeah, and I would comment on the active versus passive management. The active management, think of it as dynamic, right? So it will respond to market movements, and that's important, especially if you can miss the 2008s or even the 2022s, you will be at a long-term advantage in your portfolio. For those that do have that long-term time horizon, that's really very appealing. So TACK, if it has, by the nature of the equal weight sector positions that we carry, it will be by default underweight technology when it owns technology, which we owned from most of 23 through 24 up until very recently. So that natural underweight position would suggest that in the strong tapes that are tech-led, we would have TACK as a core holding and supplement it with other technology exposure. Usually the questions we get mostly about are technology stocks, right? So they can go buy Netflix and Microsoft and supplement those core, more boring positions, but they're lower beta, lower correlation. And even in a very strong tape, there is some benefit for financial advisors to have products that do have a lower correlation to the S&P 500 just from a risk management perspective.
But give me a sense of what you're thinking right now. So it rebalances every month. Is it the beginning of the month?
Yes, right at the beginning. So we wait for that month-end closing data to check the integrity of the models and the indicators, and then we recalibrate usually the first couple of days of the month. And with that, we reset to 12.5% sector weightings. If we had a full sector position, we would have those, all 8 buckets filled with the sectors, but we will morph into that more risk-off exposure as the market warrants it. So
in this case, did you own tech at some part in the year?
We did, yeah. We just removed tech in March.
In March, so in April now,
we have no more
technology sector is not in there, and you have weighting to gold 4%.
That's right.
Long-term treasury 4%, short-term treasuries.
Yeah, and we would expect to see that grow just because of our market call, which is for more of a prolonged bear cycle during which we will expect those alternative asset classes to outperform. That includes gold, which we've already seen develop, but also the treasury market is better suited to us right now than the equity market in terms of risk reward. And we're talking about maybe not the next 5 years, but maybe the next year or so that's going to be the case. So we're very comfortable with that natural shift.
And this recent move in the bond market's been a little perplexing, though. I mean, bonds down, yields up. You would think the other way would be happening
if
there was a concern about a slowdown.
It's a trading range. If you look at yields, zoom out, you'll see a trading range there. And yet the safety and the yield that they offer, I think, will be relatively attractive to what we're finding with the volatility increase on the equity front. So we find appeal there, but like you said, international, for those funds that do move into international markets, there's appeal there as well. The relative performance has shifted meaningfully behind some of the developed global markets. So there's a lot of opportunity, but right now it isn't what it looked like in 23 or 24, where it was so mega cap centric. And for advisors, they really can't afford to have a super mega cap centric portfolio in terms of the risk that they carry with that, right? We saw the shift very dramatically out of those names as of December, and it's become very real.